Hello, everyone, and welcome to BlackPoint Capital Partners March 2026 Market Recap. I'm Mauricio, co-founder and partner here at BlackPoint Capital Partners. And joining me today is Arun, Kaul, our Chief Investment Strategist. We're going to keep this tight, about 10 minutes, covering what drove the markets this month. Arun, always good to have you. Before we dive in, a quick disclosures. Everything today is for informational purposes only, not investment advice or recommendation on any specific product or strategy. All data and forecasts are based on current market conditions and subject to change. Past performance is not indicative of future results. And full disclosure is here on the screen. Please review it, and always consult your own advisors before making investment decisions. All right, let's get into it. Here's what we're covering today. 4 topics: the economy, rates and inflation, credit and equities, and real assets. Arun, let's start with the macro picture.
Well, to begin, Nico, really a confluence of events, some fairly positive events and some fairly negative events. And that net balance out is getting us to growth below 2%, which has been the historical trend line. We're certainly seeing a tremendous amount of growth in CapEx, new technology, innovation, whether it's AI, blockchain, or space, or some of the robotics, or even into health and the human genome. Tremendous amount of research and innovation. That's a long-term anchor that is a positive. And of course, in the near term, we've got the war, the higher price of oil, and the potential blockage of the shipment of goods, in particular commodities or fertilizers and oil and natural gas, through the Strait of Hormuz. So definitely a very mixed backdrop with a couple of extremes pointing in either direction.
Great. And Arun, Q1 growth came in lower than expected. What's the read here? Should investors be worried or concerned at any point in time?
Well, near term, we do have risks around the war and the price of energy and how that will or may flow through into certain other costs of goods and materials. Longer term, the backdrop is quite favorable. We just have to get through the short term, hopefully short term, around the war.
Okay. And the way I'm reading that, so then it sounds like this may be just a blip in time and not necessarily the start of a trend moving forward.
I think so, and I think that's what the market is looking at as well, because we really have not had that large of a drawdown in the market considering the backdrop. And certainly we want to keep a note on rates, and in particular residential home ownership and investment, much more sensitive to rates. And I think we'll touch on that later on, but we do want to see rates stay at that level they've been at the last 2 to 3 years, which would definitely support the longer term positive backdrop.
Okay, now let's take us over to what's on the top of everybody's mind, the Strait of Hormuz, the Iran geopolitical conflict. Talk to me a little bit about what's going on, how we can interpret some of the data, and what we should be keeping an eye on for Q2.
So really in the short term, with the rise in the price of energy, the focus has now switched completely to the near-term risks of higher inflation, potentially a repeat of the 1970s, where we had a lull after the first bout of inflation, and then we saw inflation again take off. I think that's a very low probability, but for now, there's definitely concern about the near term, the next 1, 2, 3, 4 months in terms of inflation, the cost of energy, the increase in the cost of transportation, and potentially the increase in the cost of end goods, such as chemicals or fertilizers that are either blocked or impacted by the increase in the cost of energy. So right now, 5-year forward, inflation break-evens are about 2.5%, which is above the Treasury target or the Federal Reserve target of about 2%, and the 1-year swap is about 2.8%. So in the near term, we're potentially at risk of going back to 3% inflation, which would definitely be a negative for markets and for the economy. But importantly, the 10-year, which is the blue line at the top of that graph, is between 4 and 4.5%, which is where it's been for the last 2 years. So if we stay in this range, 4.3 to 4.5, that's a positive, which means the market is still looking through the conflict, expecting to end in the near term and to not have a longer term impact on inflation and then subsequently on our rates.
Okay, and so you kind of went into it a little bit there, but just to dive into it just one more time, the Hormuz closure, it is a big macro event. Event of the month. Is that actually something that is moving the needle on inflation expectations, or is there something else that we might be needing to look at there?
I think near term, the answer is yes. And the longer it persists, the more it moves the needle. So the
Okay.
expectation now is that if the major hostilities wrap up in the next month or 2 months, then it's a short-term impact that can be reversed. The longer it goes on, the harder it is to reverse the short-term impact. And then it might potentially flow through into other goods, and that's really the risk. So right now we're seeing some inclination in the short term, but we're not seeing it in the 2 to 3 or 4 year windows in the long term.
Okay, and there was recently a Citrini report that came out that really kind of went against the grain, if you will, noticing that there was a pickup in traffic to about 15 ships per day. Is that something that you're seeing? And if so, what does that mean for the near-term future of potentially opening and getting this pipeline moving forward?
So from an economic perspective, the movement of some ships through helps to balance the price because it's a global price. That's the key issue here, is that it's a global price point for oil, whether it's West Texas or Brent, or whether it's light or sweet or heavy crude. So that's good, even if it's going to certain countries only, i.e. maybe China, maybe India, maybe some of the other countries that Iran delivers to directly. So it's a positive because it helps the global price at the margin. It can still be a negative for certain countries that may not be able to access oil or that have limited reserves, or I should say it will be a negative for those countries that cannot access. So we're coming to the point now where we might see very different impacts on specific countries depending on how the flow through the strait progresses or on how long it stays significantly closed, even if there is some moderate activity.
Great. And the last and most important event, obviously this is very important, but what does this mean practically for the Fed moving forward? How do we interpret that, and what is the outlook for them on that side?
So the Federal Reserve is facing what looks like a weakening labor market, or certainly a weaker labor market, and rising inflation, which is almost a worst case scenario for the Fed because they're stuck between their dual mandates of supporting inflation or maintaining low inflation and supporting employment. So right now, the bias from the Fed looks to be towards inflation and to be stricter on inflation. So we're expecting potentially no rate cuts this year. At the beginning of the year, we were seeing as many as 4 or 5 or 6 cuts that were priced in, and now we're down to 0, and maybe a probably of an increase. So we've gone full circle since the beginning of the year to today, post the Iranian war, which was the start of the last day of February. So
Okay.
for now, it looks like the Fed is sitting on hold and will not reduce rates unless they see some easing of inflation expectations, especially in the near term.
So sounds like we need some easing expectations. Hopefully this conflict gets eased out over the next few weeks/months and opens that up. But moving on then to credit spreads, stable conditions. Talk to us a little bit how we should be interpreting the credit market, and what does that affect across the equity markets as well.
Right. So on the left-hand side, we have a graph of financial conditions. Anything below 0 is considered to be loose financial conditions, and anything above is considered to be tight. And you can see how it spikes in 2020 during COVID, and then during the GFC in 2008, and prior recessions in 2000 and 1990. So right now, conditions are fairly loose, which means that rates on an absolute basis are generally low, and spreads, which is the graph on the right-hand side, are also very stable. So we're looking at corporate grade spreads in the blue and the gray line on the right-hand graph, and then high yield in the light green. And what we see is that spreads are at or near historic lows or near mid-cycle lows. We have not seen stress in public debt markets as of yet. So again, both markets, both equity and fixed income, are attempting to look through the current events in the Middle East with the expectation that they're resolved in the near term and do not have a long-term material impact on the underlying businesses or on the ability of them to repay debt going forward.
That sounds very positive. And the biggest question then is what's holding these spreads together at this point?
So you're right, it is positive because definitely rising spreads would be a sign of stress and would certainly put stress on some of the weaker balance sheets. So the perspective of the investor is that the underlying companies are still maintaining cash flow. We still have pretty strong forecast for earnings growth for the S&P 500, and we have good fundamentals in terms of interest coverage ratios and debt equity ratios. So the underlying fundamentals are positive, and the expectation is that these companies can withstand a near-term shock as we're going through for 1 or 2 or 3 or 4 months, and then maintain regular growth post that. So we have an interim period of somewhere between 2 to 4 to 5 months, again, difficult to say exactly how long it is, where these companies can sustain short-term stress given their strong fundamentals and the backdrop on the economic growth side.
Great, great. And just the last part here then is, what should we be watching a little bit more closely that may be putting up some of those signals as to the credit market, credit market maybe spreading a little bit more there.
So both the absolute rate, we want to really see the 10-year on the U.S. Treasury stay around or below 4.5, between 4 to 4.5, I think is livable, especially if inflation is 2.5. That's reasonable for the 10-year. And then spreads. We want to see spreads stay generally at mid-cycle levels, which means we've got continued growth runway. If we see spreads widen, it'll typically happen with high yield first, and then that would cause certain parts of the economy to come under some stress. We've had that in the past, like in 2016 and 2017, where we had mid-cycle stress, but it did not impact the overall economy. So we still have a couple of layers to go through before we get to the most negative situation. And then the other aspect to watch is on the private credit side, we're seeing a lot of redemption activity for some of the private funds, in particular private non-traded BDCs. And so far, all the firms have met their minimum obligations on providing repurchases and redemptions and liquidity of the funds. Now, in many cases, the investors are trying to redeem more than is allowed by the offering documents, and so they're not getting the full allotment, but they are getting what they are prescribed in law and by regulation to receive. So that's another area that we need to watch closely to see if there's more pressure on investors needing liquidity, or on some of those funds being able to provide liquidity within their mandated terms inside their offering documents.
Okay, perfect. So let's actually move in over to the U.S. equity markets. It's been the worst 2-year run against international assets or international equities since 2008. Talk to us a little bit about what's driving that underperformance and how we should be interpreting the data when it comes to the chart we have here.
So the U.S. has dominated since really 2010, right after the financial crisis. It's been almost a 15, 16-year uninterrupted run until the last 2 years. A lot of that's been driven by technology, especially since 2017, the Mag 7 and U.S. dominance in some of the newer areas of technology, whether it's AI, software, cybersecurity, data infrastructure build out, and those sectors. So what we're seeing today is some pullback in some of those areas because now AI is actually negatively impacting some of the software firms, some of the SaaS firms, and certainly the multiples have been higher. And some of the other markets are benefiting from rising commodity prices, in particular gold and silver and energy. So in general, international markets, especially emerging markets, but also IFA, also developed markets, have benefited from rising commodity prices at the expense of the U.S. markets, which have a much lower weighting in commodities, in particular energy and materials.
Understood. And does the earnings and margin advantage still justify the premium that people are willing to pay for instance, the S&P 500 versus international markets?
So I think the answer is yes. You're always going to see a premium as long as the U.S. growth numbers are higher, which right now they are. So the growth forecasts are still higher. The margins are higher, and the multiple is higher to represent that. So if you go back in time, the spread was not as great, and you didn't have as much of a differential in terms of performance within the U.S. and European markets. So as long as the U.S. has stronger growth with higher margins, you're most likely to see that premium, that multiple premium persist.
Great. And last but not least, moving on to what everybody's been keeping an eye on in the markets is real assets, oil, gold, US dollar. Talk to us a little bit about, we saw a pretty big increase in oil during some of the middle of the conflict, got up to 115. Wasn't as high as the highest it's been at 150 per barrel, but how should we be interpreting this data? What does that mean for the markets, and how should real assets be interpreted moving forward?
Right. So there's two distinct anchors for these charts. Let's start with the one on the right, which is gold and silver. Really post-Ukraine, going back to 2022, the U.S. effectively withheld Russian assets inside the U.S. or the global payment system as punishment for the Russian invasion of Ukraine, effectively weaponizing the U.S. dollar and part of the payment system, which is dominated by Western countries and Western banks. So that's a key driver of the rise in the price of gold prior to the war in Iran, and certainly post the war in Ukraine, given the global uncertainties of that trigger. So you've really got two or three events now that have combined to drive the price of gold higher. A lot of it has been driven by central bank buying. So today, now that we have some stress from energy, you're seeing some of the central bankers or some of the other investors utilize gold or silver either for liquidity or simply to take gains, given we've had such a large run in those assets. I think long term it still stays as an offset for central banks to diversify their holdings away from the US dollar. I think all central banks will do that, or will certainly look at reallocating higher and to these precious metals, potentially to crypto as well, and at the expense of the US dollar. On the left, the price of energy is purely driven higher post Iran in the last 2 months. So that move is because of the closure, because of the beginning of the fighting, and then the closure of the Strait of Hormuz. So that, at the moment, we think is temporary and will be resolved with the cessation of fighting and either some kind of truce or wind down of the war. I think it may be messier than some people think. The fat risk tail might be longer, but as long as it starts to move back towards 70 or 75, let's say 70 to $80 is probably comparable to the inflation adjusted price of the last 5 years, at least in the US. So you've got two or three different cross currents at play with energy and with gold and silver, some of them overlapping and some of them not overlapping.
Yeah, and so just to understand that a little bit more, I think you mentioned a pretty important piece right there when it comes to oil and where the inflation adjusted price is. Just to clarify, is this a geopolitical premium that people are paying, or is this a structural supply shift that we're seeing, and how is that going to be positive or negative for us looking at oil as an investment moving forward, or how that affects economies across the world?
Yeah, it's a good question. I think you can answer it's both. So the graph on the left is the inflation adjusted price of oil in the US. So that's West Texas crude divided by the CPI Consumer Price Index in the United States. So certainly there's a geopolitical component in that. I don't think we're going back to the pre-world order of simply relying on the Strait of Hormuz to always be there for shippers. So whether that's Saudi Arabia or UAE building pipeline or alternative capacity to the west or through the Mediterranean or through the Strait and the sea on the western side, or towards countries looking to more alternative sources, whether that's solar or wind or other alternatives. And then certainly there's the direct risk premium today with the closure and the reduction in supply. So you really have both going on. In the near term, it's certainly the reduction in supply that is the most immediate impact of the premium that we're seeing today. And obviously the loss of potential future supply once we run through some of the reserves. So your comment earlier about the trickle getting through is definitely critical to help seeing a further spike or an actual shortage. So right now we've got very high prices, although not on an inflation adjusted basis. We can see that dot on the right hand side is the inflation adjusted number. So we're certainly lower than 2009, 10, 11, 12 up to 2014. So while the price is high on an inflation adjusted basis, we have been here before from a US perspective.
Yeah,
but I think the question, you've got both. You've definitely got both premiums in there. Certainly the short-term cut in supply is the larger of the markup, And then I think the backdrop geopolitically is that we may not see it come as low as we would like, depending how the situation is resolved.
Yeah. However, the positive is as that does start to come down, then that may change some of the conversation around inflation, rates, things of that nature.
Yes.
Great. Well, thank you very much for that, Arun. All right, to bring everything together, some of the 5 key takeaways from March. One, first and most important, the Strait of Hormuz close is a defining macro event for the month. Oil is up roughly 70%. That single development has reshuffled the outlook across rates, inflation, and equities. Second, Q1 GDP is now tracking at 1.6%, down from 3%. An export to deceleration and a pullback in residential investments are some of the main drivers of that revision. Third, the Fed is on hold for now, and there's only a 10% chance of a rate cut by year end. And notably, there is now 9% probability that the next move is actually a hike. The easy narrative is off the table for now. Fourth, US equities are in their worst 2-year run relative to the international market since 2008, and the valuation premium is compressing. And that's a conversation investors and we here at BlackPoint are having, need to be having moving forward. And fifth, the last one, gold has pulled back from its highs as real rates have risen, but the commodity story of this month is oil, and how does that go from start to finish throughout this geopolitical conflict? Arun, thank you as always. Always great to have your perspective. And to everyone joining us today, thank you for your time. If you have any questions, please don't hesitate to reach out to info@BlackPoint CP or your individual advisor that you're working with. Thank you very much. This is a wrap for market recap for the month of March 2026. Thank you very much for your time today. Thank you very much, Arun.
Thank you.